But, being a true bridge capital provider, you have the ability to do deals that others would not, right? Like we'll look at deals, like I said, this condo in Midtown Manhattan, most other lenders would not, right? This restaurateur that I just got off the phone with, most lenders would not touch that. But being a provider of capital, you have to be fluid. You have to be flexible on the type of assets that you're willing to do. But most importantly, having safety at top of mind.
Yeah, because you want to make sure what you're going into is stable, and you always want to know when you're getting out, right?
Oh yeah. One thing that we pride ourselves in is the fact that while deploying $700 million across about 1,400 loans, we've never lost a dime of principal.
Oh, nice.
I want to be able to keep saying that forever. Not easy to do, but being a bridge lender, being a first lien lender, collateralized by real estate, personally guaranteed by the operators, enables you to say that you've deployed $700 million across 1,400 loans.
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you in your journey to success. How you doing today? It's Scott Kidd, Yacht Captain Investor Podcast. I have a friend of mine, Ruben here, a fund manager, runs a debt fund. How you doing today?
Awesome, Scott. Thank you so much. It's been a long time coming, and it's a pleasure to finally be here.
Okay. Well, really appreciate you coming and talking to us today. For people that don't know you, just give us a brief intro about who you are and what you do.
Sure. So we are a direct private lender, true bridge capital, essentially providing bridge financing for real estate operators and investors, predominantly in the East Coast, the Eastern Corridor. So anywhere from starting from New York all the way down to Florida. But we have the capacity and the ability and the willingness to go nationwide. We've done deals in other parts of the U.S. that I've never even visited, at least not yet. So we provide that short-term bridge capital for those real estate investors who are buying essentially kind of value-add properties. They're fixing them up and they're flipping them, or they're essentially in a bind, right? It could be that they have some kind of partner dispute. They have a technical default. They need to pay out their existing investors, their partners. There could be situations of unfortunate situations of divorces. They need to pay out and pay off their wife, or vice versa. The wife has to pay off their husband. It could be that they're in a project that's taken a little longer than expected, needs a little bit more liquidity and capital. So we provide them that capital and the liquidity for them to finish their projects. Or at the very least, sometimes, they're in a position where the property is not essentially kind of mortgageable because it's not rent rolling, it's not stabilized. So they come to us to provide them that bridge to stabilize the property and ultimately take out their existing lender. So that's kind of who we are in a nutshell. But, we founded the company about 8 years ago. And since then, we've originated about $700 million across 1,400 loans. Average loan size nationwide is right around $500,000, but in our backyard, it's right around $2 million, which is New York, New Jersey, and Connecticut. And we have the capacity to do deals as small as $100,000 all the way up to $10 million. We're very proud of that. Prior to this, we were fix and flippers ourselves, buying, selling, flipping, developing real estate here in New York, predominantly Queens, Brooklyn, Bronx, and coincidentally came across private credit and have never looked back since. So it's truly an honor to be a lender versus, essentially an equity player, because you're in the safest part of the capital stack. You have so much subordinate capital ahead of you. And most importantly, it's true passive income. Yeah,
well, that's really great. It's really great for people to know that, there are tools and instruments out there. Like, so you do some kind of also bridge and gap funding. And I imagine gap is a little bit more expensive than bridge.
Yeah. So, in my definition, I know this has always kind of been a perplexity, right? As far as what does gap funding really mean? According to my definition, I wish we had like a glossary for private lenders and just, real estate in general. Gap funding, in my opinion, is like financing for a down payment, right? Or an earnest money deposit. Not something that we do. Me and my investors, thankfully, we want to be able to be in a very secured position when we deploy our money. So we always want to have real estate as collateral, not a contract, right?
Yeah.
So we always want to be a first lien lender. We always want to have collateralized real estate and also personally guaranteed by the operator. So, a lot of our investors today, they're high net worth, ultra high net worth individuals who have full-time jobs. They want to be in real estate. They want to invest into real estate, but they don't have the wherewithal and the availability to do so, right? Because as much as we want to coin real estate as being passive, when you're a real estate operator, it's not passive, right? It's far from passive. It's truly active,
Yeah.
right? It's toilet and tenants. Someone put it to me a couple of days ago. Toilet. I think it was you who put it to me, right? Toilet and tenants.
Toilet and tenants.
Exactly. Who wants to deal with toilets and tenants? So a lot of our investors, they're in a position where they're not looking to get rich. I mean, who doesn't want to get rich, right? But they're looking to maintain their wealth. They're looking to stay rich. And that's why they're investing with us. So gap funding, as much as I like to maybe deploy some money in there because it's a high yielding return, for us, it's just too much of a high risk to be putting our friends and family dollars behind it.
Yeah, I would imagine, because that's kind of the riskiest dollars. Like it'd be like, in our development deals, usually the riskiest part is the land part before it's all entitled and stuff like that, and that's where the riskiest money comes in. But that's where generally you make the higher elevation in the equity when you do, because once it's developed, once the land is entitled and everything, then it's it's worth a heck of a lot more. So I mean that's good. So
It's a good point.
Yeah,
It's a good point. Forgive me to interject, but that's actually a very good point. We were looking at a deal recently in Fairfax, Virginia,
okay.
and the operator had a very large private loan, right, a bridge loan from an institution that I'm very familiar with, and the loan was for about $34 million. And they came to us to be able to take out their existing lender and give them some more capital to continue on the efforts of getting the property rezoned, right, and getting it entitled. The challenge was that they were in the deal for 2 years, and a big part of and there's two projects. They're kind of minutes away from each other. One of the projects did get the entitlements, right? They got approved, but the other one did not. And he did not want to start one without the other. So now he's in a little bit of a pickle, right? So for us, as much as we like those type of assets, we had to kind of stay away from that deal.
Yeah.
Although at some point we were strongly considering giving them about $25 million, which would require them to come in with about $9 million of equity into the deal to pay off their existing lender, plus the capital that they needed to finish the project. We ended up stepping away from it because we just weren't confident in their ability, lack of their ability, but the willingness of the local government policies and politics to approve the entitlements that they needed, very much needed, to get the values that they were hoping and predicting. So I think for us, at least for now, the capital that we have, it's very retail investor driven, right? And not institutionally backed. We do have warehouse lines and credit facilities by other groups that are institutional in nature, but eventually, maybe later down the road, we will get there. But entitlements and rezoning and these type of big kind of deals, in terms of the hopefulness of them getting something done in the future, which sometimes is beyond their control, is something that we're trying to shy away from, at least for now.
Yeah, and it can get really complicated, especially when you're dealing with city government, state stuff like that. I mean, we have one project, Cedar Hill, that we're working with, and our co-development partner is actually helping rewrite the master plan. So they're really the city's the one filing the entitlements and the permits and everything. So there's a bit of a big plus there, because like they're not going to go against themselves to, at least with the government that's in there right now and the councilman and everything, they're going to hopefully fast track it, but or at least, there's probably a 99% chance that they make it through. But
and generally that's the case, right?
Yeah.
Generally, that's good. What state is that in, if you don't mind my asking?
That's Texas.
Texas. Okay, so I mean, look, red states, they're a lot more kind of friendlier when it comes down to deals of this caliber, right?
Yeah.
Whereas the blue states, I mean, I don't know what they're trying to do. One side of them is kind of screaming that housing is too expensive and it's unaffordable, but yeah, on the flip side, they're stopping from anyone developing, right? They're throwing roadblocks for
not
everyone.
in my backyard. Stuff happens a lot, and It's,
Exactly.
we want housing, but we don't want all the development construction for a long time. It's like, well, you can't have cake and eat it too. And there's no real way that it happens without investors and developers. And there has to be, some incentives from the government, city, state, local, federal government, which there's a lot of federal ones that just came through with the accelerated depreciation and,
Huge,
cost segregation.
just
Yeah,
huge.
and what I did like is that they made it forever.
Right.
So, so because we need a lot of housing, and you see, and I've ever tracked a lot of the government housing that it's usually overpriced, overbuilt, there was a house, I think, they were building units in California somewhere. I know California, everyone beats up on California as far as regulation and stuff, but
I
this
mean,
is one,
California and New York are very alike in nature, right? I
yeah,
mean, I was listening to Andrew Cuomo speak on CNBC last week, and he said it well, right? I mean, he said that the permitting in New York City for
yeah,
you to build something in New York City can take up to 4 years.
yeah,
So you can imagine as a real estate developer, right, who has, other projects that they can be doing in other states like Texas, which
yeah,
is very wise of you to do,
yeah,
right? Texas is super friendly. You can get permits and permission to build and entitlements fairly easily, right? They obviously have their own regulations to make sure safety is top of mind, which is
yeah.
very, very important. But essentially, it doesn't take 4 years, right? And as a real
No.
estate developer in New York who wants to bring more housing to the neighborhood, right?
Hmm.
You got to start considering, all right, even if I do still want to deal with this mess, four
Hmm.
years of carrying costs, whether you have a
Yeah,
private loan, whether you have pref equity, mez, right? Or just taxes and insurance alone, if you just bought it all cash, which who does nowadays, right?
yeah,
That is eventually going to be passed down to the tenants. That's eventually going
yeah,
to be passed down to whoever is buying or looking to buy. So, for those of us especially in New York, who are screaming, we need more regulation. At the same time, they're yelling to defund the police. At the same time, they're yelling, hey, you know what? We need more affordable housing. You need to start reconsidering the policies that they're putting into play to be able
yeah,
to actually be a little bit more friendlier for the operators who are actually doing the grunt work of
yeah,
developing and bringing more housing and actually making sure that, the public safety is top of mind. So it's a juggling act. I think California and New York are very similar
yeah,
in nature. And obviously the numbers are proof in the pudding, right? Because
yeah.
at the end of the day, I was on another podcast earlier last week, and the gentleman is from California, and he said this was the first time in California history where there was a net loss of people moving in, right? So for the first time, they had more people moving out than they had moving in, right? So that is a testament of what's to come and what
Hmm.
needs to be done. And what needs to be
Yeah,
done is the right thing of just being more friendlier to real estate operators who eventually are the ones who are feeding those states as well.
yeah. And I just had a friend of mine, Brian Bannock, on. From the Bay Area. He's in the Bay. He's been there his whole life, and he's an absolute expert in that area. And he said there are certain ways to do it, and it's like there's where if you are investing in California or New York, you find somebody like him that knows all the nuances, knows where to do the permits. He has, I think, a piece of land that he's been developing. It's 2+ years already. He's unable to break ground,
Oh,
by that yet.
goodness.
But it's a piece of land he's owned for a long time, so it's a different, you know what I mean? He's going to do something eventually. He's got a bunch of other stuff going on because he's got
Right.
brokerage, a mortgage, and he started a fund. He's a developer. He's got pretty much the whole gambit of everything he's done in California and nationwide. So that's one of those things where you got to find somebody that's a local, expert and stuff like that. Because I have a friend in Colorado. It took him, was it 20 months before they could even, they bought an 11-unit property, which 9 of the units were unpermitted. So the city wanted him to tear it down, but it took them almost 20 months before he could even knock it down.
Unreal.
You know what I mean?
Unreal. I mean,
And he's like, but the good thing is, when I'm done, it's going to be a $1 million plus house. And I'm like, but because I know a but was coming. Yeah, but it'll probably cost me $1.5 million.
Unreal. I mean,
Yeah,
look, those are the pitfalls of being real estate operators, right? No one really shares, everyone shares the wins, but no one really
yeah,
shares the losses, right? I mean,
yeah.
and I've shared this multiple times on a number of different podcasts and videos, and that was the fact that we had a tenant at some point that didn't pay us for 5 years, and I couldn't get her out. Right? She was just a pro. She
Oh,
was
she knew what to
smarter.
do.
She knew exactly what to do. I mean, she outsmarted all the attorneys that I've basically retained on this. Some good attorneys, right? This is all they do is L&T work, landlord tenant work, and she outsmarted them. And it's not because she was just a smart lady. I think she was, but I think it was more because the system is just in her favor.
Yeah,
All she had to do was file an order to show cause. And guess what? That just gave another extra year, right? A year
yeah,
and a half, right? By the time the system, by the time it goes through the system and I'm able to get in front of a judge, just takes 4 to 6 months, right?
yeah.
And
And
guess
then
what?
even if you're wrong,
All
you
she has
make
to
this
do is
success.
come in front of the judge and say, Your Honor, I want to get an attorney. Wait a second. You had 6 months to get an attorney. What are you doing
Yeah,
here, asking for an attorney
and you
now?
don't
You
have an
knew you
attorney.
needed an attorney, right?
Yeah.
Like what? And guess what? The judge just says, Sure, no problem. We'll
Because he,
postpone.
he has to allow, or he or she has to allow them to get an attorney.
And by the time that new date is scheduled or put on the calendar, it takes another 4 to 6 months. So just, a year's worth of fluff, of
Yeah,
nothing. No arguments are made as to why we're here. Why
yeah.
are we in front of
She
you,
could
Your Honor?
be in the complete wrong the whole time.
Oh yeah.
If she just
Oh yeah. And
plays the
guess
steps.
and the best part is behind all that is that that same week she'll be calling me saying, "Hey, you know what? My microwave just broke down, and I need you to bring me a new microwave." And God forbid if I don't, guess what? Another order to
No,
show cause is
she
filed,
sends
and another
another
six
one.
to 7 months,
Yeah.
killed. So, being a real estate operator is not easy,
No, it's not.
and we as lenders, we appreciate that. We understand the complexities that it takes to navigate through the real estate markets. And as a result, if you look at our book today, a good 70% of our borrowers, actually 83%, forgive me, 83% of our borrowers are experienced operators. Buying, fixing, flipping, developing real estate is all they do, right? Don't get me wrong. On occasion, we'll have a doctor who wants to start dabbling into real estate because he's watched HGTV. He thinks he can do it,
Yeah.
and rightfully so. It's possible that he can, but then he quickly realizes that he has to probably take some time off from his practice, right?
Yeah.
And he's probably going to be losing more money taking time off from his practice than he is earning the money that that he
Yeah.
thought that he would earn by being in real estate. So, we try to focus on experienced operators. On occasion, we'll come across an inexperienced guy, and what we do in those scenarios is we hedge by reducing the leverage, right? We want them, the inexperienced novice investors, to have a little bit more skin in the game and be a little bit more involved in the deal, because having skin in the game, more skin in the game than you normally would, is the best leading indicator of your interest in making sure that the deal will get to the closing table.
Yeah. Most definitely. So what, as far as like vetting your clientele and stuff like that, a new client, that's one of the main things you look for as far as
Yeah.
is less leverage, more skin in the game. And what
Depending
else
on
would you think?
depending on the operator, depending on the asset class, depending on the location, right? Don't get me wrong, we've funded and originated deals at 90% of acquisition and 100% of the construction, right? That's generally on a 1 to 4 unit fix and flip to a really experienced operator who has done at least 2 or 3 or 5 or 10 or 20 of those flips in the past, right? They this is all they do. They don't have a full-time job. Their full-time job is being real estate operators. So we'll go up to 90% of the purchase, 100% of the construction on the 1 to 4 units. Right before this call, I was on a call with a restaurateur, right? He was purchasing a mixed-use property in Gainesville, Florida, and he was
Okay.
purchasing it as a bank REO. This was going to be their 6th restaurant. It's similar to like Shake Shack, right?
Okay.
Very similar in nature. And it was going to be their 6th restaurant. And, he was looking for maximum leverage. And he was, I was basically, when I was giving him terms, I was competing with an SBA lender.
Okay.
And, what we offered him was not 90% of the purchase price. I offered him 60%, maybe 65% of his purchase price. And the main reason why is because of the asset class and the location, right? It's a restaurant. There's only one use for it, right? He was also going to be the owner and the operator. So when we look at deals, we look at it from a holistic perspective, right? Our number one focus in the beginning is the asset, right? What are you buying? Where is it? What's the purchase price? What's the renovation budget? What's the resale value? What's the after repair value, right? All those questions, right? And then after that, we look at the borrower, right? We look at the sponsor. We look at their credit. We look at their background, right? We want to make sure that they don't have any bankruptcies. They don't have any foreclosures in the past, right? And if they do, it happens on occasion. They don't have any kind of money laundering, criminal activity or anything like that. That's
bad boy acts.
exactly. We want to stay away from groups like that. Although I got to tell you, we actually funded a deal once for a person who actually did 25 years in jail.
Wow.
Yeah, he was, I think, 18 years old when he committed, some foolish crime. I think he did 24 years. Forgive me. He did 24 years in jail, and he came out of jail. He was a completely different person, right? I didn't know when he was 18, but when he came out of jail, he was strictly business focused. And when he came to us for financing, it was already his, I think, 14th or 15th flip. Oh. And, if you look at it from a perspective of would you ever fund this guy, the answer is probably no, right? He's potentially a bad person, right? But then again, there's a lot of people that come out and they've done good things since. So
they paid their time, so you got to take a second look at it,
Exactly. And he was 18 years old when he made that mistake.
Truthfully, a lot of those guys, when they come out of prison or what have you, there's not much for them to do other than, they go back. The reason why they keep repeating is because they go back to the same people that they're around. And then unless they're really focused and want to start a business, because they're not really going to they probably won't get a decent job because they have the mark on there. But if they work for themselves, and real estate's just another example of some place where it can be very forgiving with that. Over time, you can, scrape together the money and put your down payment down, and, hey, somebody will give you a shot, but it's, like you said, getting back to being the active operator, a lot of people say they want to get into it and they want to do it and this and that. But once they get into it, because I've made that mistake myself, like where, midnight, I'm dragging pipes out, cutting concrete, doing all this stuff. And then I still got to go to work the next morning at 6 o'clock, or what have you. And so, that's why we're, looking at doing some other things.
Right.
That's why I, focus on the capital side, because I'm still working on the boats and stuff. But I can see, your talk on how, a lot of people, the benefits of private credit for people, because it's just another way where you can actually be involved in real estate, but you don't have to do the tenants and toilets. And I think it's a great point that you made, because we're also looking at launching our fund to eventually have some kind of private credit, not just for other people, but mostly to fund ourselves. But what would you say?
Which is genius, by the way.
Yeah.
Which is genius. If you have the ability to fund your own deals that, you're willing to put your own money behind. That's smart, right? That's just going to alleviate a lot of headaches and, hiccups down the road. And I think that's just going to improve. Exactly. That's going to improve the execution on the equity side, right? It's going to make things a lot easier.
Yeah. And also, if we're bringing in other investors and stuff like that, they see that we have more skin in the game, and they're coming alongside us along with other institutional partners. It's an easier thing. And if they want to come in just on the debt side, because some people, that's all they want to do, but other people want, because there's a lot of times you get a bigger pop on the end with the equity side.
Oh yeah. You also have the beauty of depreciation, right?
And you get the tax advantages, that's
exactly,
like I recently did a video on self-directed IRAs, and the things like what you're doing with the credit fund and stuff is great for stuff like that. Steady return. You don't need the tax advantages because it's already built in to what you're doing. So you don't need the depreciation or anything, and you get the steady 8, 10, 12% or what have you, that you're not going to get that in the bank. But if you get I'll take a stable straight 8 to 10% over a stock market up and down, because you never really truly make back that equity. It takes a lot longer than you might think.
Yeah. And
So
I
that's
think, as a private credit operator, right, the fund manager, having, the self-directed IRA investors is definitely a value. And the reason why is because guess what? They're not cashing out their
no,
distributions, right? They're reinvesting it
yeah,
with you. So, that just goes naturally. We have
yeah,
a few of those and they've been loving us. They've been referring investors to us as well with their self-directed IRAs. I mean, it's a no-brainer because guess what? A self-directed or IRA that's sitting with another, fund manager essentially, their real motive and goal. And I don't want to kind of, paint the broad picture with everyone,
yeah,
but
yeah,
most of the guys that are managing other people's money when it comes down to making investments in the stock market is they're really driven based on fees, right?
yeah,
They want to make as much fees as possible. They're not really happy when someone tries to pull out because guess what?
yeah,
That just reduces their AUM, their assets under management, and their dollars in terms of fees. So
yeah,
I think that that's something that has to be tread carefully when you have an IRA. You got to see exactly where they're investing, and generally speaking, a lot of the guys that have invested with us with their IRA, if they looked at their record of performance, their performance was only about 6%, right?
hmm,
On once the fees and all the other
yeah, and
things are taken
everything's
out,
taken out.
right? They're obviously the fund managers or the money managers are saying, hey, we're hitting 12% or 8% or
Yeah,
10%. But after net of fees, you're looking at about 5 or 6%, maybe 7%, right?
yeah,
And there's a lot more risk with those type of investments. Whereas, for private credit, when you're investing into a private credit fund, you're the first one, you're the last one into the deal rather, but you're the first one out. You have
hmm,
so much subordinate capital that's sitting ahead of you, right? It's just a lot more safer investment than say the stock market, which has its ups and downs, right? I mean,
hmm,
it's true. It's been proven. The only time that you're really kind of safe is maybe investing into the S&P, right?
yeah,
But being a private credit provider, investing into a fund, one, it's truly passive, right? You're hitting diversification because your money is going into a number of different deals, a number of different assets, a number of different locations. It's not just going into one stock or one group
hmm,
or one company, right? And it's receiving cash flow instantaneously. And guess what? When you're in an IRA and that cash flow is reinvested into your IRA, well, guess what? You're getting the power of compounding, right?
hmm,
And that in and of itself is just a testament as to why a lot of groups have been, investing with a lot of investors have been investing with their IRAs into our fund as well.
yeah. And I think it's just another thing to emphasize that there's so many different ways to do it, and private credit is another great way to where you can diversify your own personal holdings, and you can diversify your retirement, your self-directed retirement. Or if you just wanted to have some income instead of putting the money into the real estate, you want to make a general return, but you are going to have to pay taxes on that. That's why the self-directed IRA is a great way to do it, because it just keeps accumulating, and you guys do monthly
Yeah.
distributions. Oh,
Yeah.
that's
So
right. You told
we
me.
do monthly distributions. Exactly.
So
Our
that'll
investors,
compound. That
ex-
compounds a lot faster.
oh
At
yeah.
that point, you just keep reinvesting it, and then what would you say is you guys' sweet spot as far as assets that you guys loan on?
I would say anything between as small as a single unit all the way about to 50 units, right?
Okay.
Mixed use properties. We try to stay away from office. We'll do some retail. We'll do some industrial, right? Kind of depending again on the asset, depending on the borrower when it comes down to industrial and retail. I'm looking at a deal right now. It's a luxury condo in Midtown New York, right?
Okay.
Where it's actually a foreign investor, right? She has her, documents to be in the U.S. for the next, I think it's 554 days remaining or something like that.
Oh, really?
Yeah, so she's looking to bridge, her acquisition. She was going to buy it all cash, but by the time she gets the money here to the U.S., she just needs to bridge that acquisition. She has about 40% of equity into the deal that's ready to be invested, and I'll be only at 60% leverage. So for
Really?
us, deals like that, we'll do them all day, right? She has great credit. She's not a real estate operator, but she's looking to start building her portfolio here in New York City, right? She
Well,
clearly
that's
comes
great.
from a very wealthy family. The acquisition is for about $5 million, and she's coming in with about 40% of the equity. So for us, deals like that, we'll do them all the time. But I would say the bulk of our business today is anywhere between 1 to 50 units. A lot of our borrowers are buying, physically, financially distressed properties. They're buying them off the auctions. They're buying them at the foreclosure footsteps, right? They're buying them off market because this is all they do. They have the ability to find those deals, and they're buying them with the intent of repositioning it and ultimately either refinancing into a term loan or reselling the property to an end user, right? Or to another investor who's looking to hold on to the property long term. So that's kind of what our sweet spot is today. But, being a true bridge capital provider, you have the ability to do deals that others would not, right? Like we'll look at deals, like I said, this condo in Midtown Manhattan, most other lenders would not, right? This restaurateur that I just got off the phone with, most lenders would not touch that. But being a provider of capital, you have to be fluid. You have to be flexible on the type of assets that you're willing to do. But most importantly, having safety at top of mind.
Yeah, because you want to make sure what you're going into is stable, and you always want to know when you're getting out, right?
Oh yeah. One thing that we pride ourselves in is the fact that while deploying $700 million across about 1,400 loans, we've never lost a dime of principal.
Oh, nice.
I want to be able to keep saying that forever. Not easy to do, but being a bridge lender, being a first lien lender, collateralized by real estate, personally guaranteed by the operators, enables you to say that you've deployed $700 million across 1,400 loans and never lost a penny of principal.
And that's kind of a testament to also your vetting process and just how much more stable that business plan can be by you picking and choosing, one, the borrower, and two, the asset, and just the people you choose to do business with. And you probably have a lot of repeat business that you probably have gone with for a long time.
Yeah, 65% of our loans today are with returning borrowers, who have done deals with us in the past or actually have an existing loan with us in the past. And that just kind of amplifies the security because, if they have a loan with us today, our loan documents have cross default and cross collateralization kind of language, right? So if you default on one loan, I have the ability to default you on everything, right? So, that is another reason as to why a lot of borrowers are always performing because they don't want to be able to be cross defaulted on all the other loans. But I think focusing on experienced operators, returning business, people who know what they're doing, is of focus for us. Obviously, that comes at a cost to us because an experienced operator is not going to pay the same price or terms or rate as an inexperienced operator would, right? But we would rather take a little bit of a haircut on our personal cash flow and make sure that the principal is returned, the principal comes back to the fund, versus having to take deals on that's a little bit more riskier. And look, another point that I would like to make is that while we've already funded about 1,400 loans, and don't tell my borrowers this, but we've denied probably about 4,000 or 5,000 loans, right? So, we have an approval ratio, and we usually see right from the first phone call, right from the start, what we'll do and what we won't do, right? For example, if this restaurateur was asking for 80% leverage on his acquisition, I would just tell him right off the bat, hey, it's not for us. We want to be safe. We'll give you 60, 65% leverage. And if he chooses to proceed, great, we move forward. Otherwise, it's not for us. And I think that today, while we've funded 1,400 loans, we've denied 3 times that, right? And it could be literally something from just first phone call that we've had, or something that came up during the underwriting through our due diligence and our process of making sure that we're making good loans to good borrowers and good operators.
Well, and that's just kind of a testament to your stringent process, and your investors will make them happy. Also should make your borrowers happy too, because they know you're not going to just loan on anything.
Exactly.
You aren't going to go out of business because you're not going to have money all out in the street. That
we're here for the long term.
It's not going to come back. What would you say now? The average is probably, if your loan to value is probably 60 to 70%, probably.
So to experience, because again, most of our loans are with experienced operators and investors. I would say on average right now we're at about 80% leverage against the borrowers as is, against the borrower's purchase price. Now, That may sound a little high. However, most of our borrowers, like I said earlier, are experienced operators. So when they're buying properties, they're buying them already at a discount of the as-is value.
Mhm.
And it's usually anywhere between 5 or 10% discount of the as-is value. So realistically, if we're giving someone 80% financing against their purchase price, guess what? We already know that the value of the property is greater than what they're buying it for, right? So realistically, we're financing them at about 70% of the
Yeah.
property's as-is value.
Yeah.
And that's a very important figure and number to keep in mind, because then, when there's 30% equity built into the deal, 40% equity built into the deal, guess what? The borrowers have a lot more reasons to perform and execute on their deals than they do not, right? So I
Yeah.
think having them have skin in the game, just like we have skin in the game alongside our investors in our fund, we're invested alongside with them. Every deal we make, we originate, we invest into those deals as well. I think having skin in the game and that alignment of interest with your borrowers, just like we have with our investors, is critical.
Yeah, the alignment of interest is very, very important. That's something that any new or old investor should always look for. Even if the relationship is long, every deal is different. So make sure you have alignment of interest. Because things happen in life.
Oh yeah.
Where people start to take more risks and stuff. You have to maybe think of that. Maybe that's a little bit of a red flag for you continuing that relationship. But it's all a relationship business. So, what you're doing, since you have 65% repeat customers, that just means it's a long haul business
Oh
for you
yeah.
guys. And the terms are probably, a lot of them are probably short term, 6 months to a year, probably a lot of the loans.
Exactly. So most of our loans are for a period of 12 months. On occasion, very rare occasion, we'll do a loan at 18-month terms, right? Which means
Yeah.
that, at the end of 12 months, the borrower has to repay our loan as a balloon payment, right? All the payments that
Okay.
they're making, during that 12 months are essentially interest only. And
Mhm.
then at the end of 12 months, they either refinance or resell the property.
Yeah.
So
So there has to be a takeout or something like that at that point.
exactly. And our borrowers haven't had, issues with that. In fact, most of our loans are repaid within 8 to 11 months. And that is a testament as to why, being a lender, a bridge lender, is also very safe, because, the loans that you make are very short duration, right?
Mhm.
They're short-lived. So your exposure in the market, in the real estate market, is very short in nature. So as a result, any kind of market headwinds or shifts, you're able to be in and out of deals so quickly that, it really mitigates any risks involved with the market shifts that's coming or yet to come.
So are you guys generally, majority of your loans, like that standard kind of hard money loan where it's 2 points, 12%, the
Exactly.
two
So
and 12 kind of model, but
yeah,
it varies with the customer and their property,
exactly.
right?
Exactly. It
So,
depends on the borrower's experience. It depends on the borrower's kind of background, right? That's really what it comes down to. But most importantly, also the asset class, right? Some asset classes have a little higher grade of risk involved with it, right? Versus, for example, an office, right? We don't normally do it. On occasion, if there's a mixed use component to it, meaning there's office on one floor and then there's residential spaces on the other, we'll do something like that. But that comes at a higher grade of risk. So, the cost of capital, the rate on that loan would probably be about 100 basis points greater and higher than, say, on a 1-4 or a 1-20 unit building, right? So obviously the higher grade of risk on the asset class, the higher the rate would be.
mm, yeah, that makes a lot of sense because you really have to go down your checklist of what you do. But
Yeah.
I think this is a great learning lesson for a lot of people, that this is another way to get into real estate, where you don't necessarily have all the issues that you can have as an active operator. Because I've had people tell me, "Oh, you guys are doing development." I've always wanted to develop I'm going to build these townhomes on this lot that I have and everything else. And I was like, "Well, have you done it before?"
Right.
And
Right.
no. And I said, "Well, find somebody who has, and talk to them find somebody in the area first, and maybe go through it with them and see, or maybe have them co-develop it with you, or
Yeah.
something like that, since they got experience, because trying to take that on by yourself, you're probably it's going to be a lot more overwhelming than you might think. Not to say that you can't do it or you shouldn't go for it, but I've done things where I jumped in with 2 feet and I almost lost both of them. So
To your point, one of the first deals that I ever purchased was in Bushwick, Brooklyn.
okay.
And it was a construction budget renovation it was a 3-unit property. It was a construction renovation of about 400 to $600,000. That's what it came down to, right? Originally, it was only supposed to be about 400,000. But on a deal of that size, as a first-time operator, I probably would never lend to the guy, right? But to your point, as far as partnering with someone that has the experience is critical, because I didn't take that deal on myself, right? I have my older brother who was in the world of construction for many years prior to me taking on that deal. He had skin in the game alongside me, right? And he's my older brother. So, whatever we do, we always do together. So he was, essentially kind of running the project, right? And if it was just me, I would never take that project on.
Yeah.
But having a partner like my brother who had the construction experience for many years prior to that was critical. So to your point, yeah, you're right. Bring on a partner if you find a deal, and sometimes look, you just have good luck, right? You find a good deal that others couldn't, or you just know the next door neighbor that's selling the property and there's so much value and upside to it. Bring on a partner, right? That has the experience to finish it through.
Especially if someone partner has the experience, they might what you think is a good deal, they might make it into a great deal.
Exactly.
But make sure you choose carefully who that actual partner.
And
Make sure you're in alignment. Same thing like the investors and everything. Make sure that everybody's in alignment, because if you have kind of a funny feeling in the beginning, it's probably not going to go away.
Exactly. And to your point, it's also possible that you're looking at a deal, you're underwriting it as an investor, a novice investor, and you think it's a great deal. And then you come to your lender or to your partner who has a little bit more experience, and he breaks it down to you and says, "Hey, it's a horrible deal, and this is why." Right? So he just saved, or the lender just saved you a ton of money, a ton of time, and a ton of headaches from going into a deal that potentially could lose money.
Yeah, and that's a great point, because a lot of times there's a reason why it doesn't pass the underwriting.
Exactly. And we as lenders, while we're not partners in the deal, right? We're not equity holders in the investments that the borrowers are making. We are essentially kind of indirect partners, right? Because their success is our success. And, a lot of times we'll turn down a deal, not because of the borrower's merit, right? It's not because the borrower doesn't have the experience or anything to that effect. It's very possible the deal just doesn't pencil out. And I'm honest with the borrowers, right? I tell them, look, you're buying the property for X, you're putting Y renovation, your carrying is X. You're going to be breaking even if that, right? So I don't want to go into a deal where you're not making money. I want you to make money. And a lot of times, like especially the experienced operators are saying, look, Ruben, I have a crew of about 50 people working, right? Construction guys. I need to keep them busy. I want to be able to buy this deal, not because I want to make money, but because I don't want them going to another project or to another developer. I need to keep them busy. And, in scenarios like that, like we get it. We understand the thesis. And, in situations like that, we'll just have them put more skin in the game. And, we're going to be at a much more conservative leverage point than we would be had the deal be breaking profit.
Yeah. And it's probably one of those things where they want to keep their guys working, so the value there is high for them, because a great worker, especially in the trades, is tough to let that person cut him loose. And they probably see that maybe in the first year it might be breaking even, and then it's probably a 5 or 10 year play where real estate's very forgiving, so that over time, if it's his guys fixing it up, it's going to be done right, and they're going to put in the best stuff they can put in at that time. And so it's kind of win-win for that person, because they get to retain those guys, and then they also get the property on the back end, which it's all a long-term play anyway. And if he's got less leverage in there over the long term, it's kind of better for them anyway, because he's already got the equity in there, and he'll be able to get tapped at some point. But,
Exactly. You hit it on the head.
Yeah, and This has been really great. I appreciate you coming on and sharing
Same
all
here,
this stuff
Scott.
with me. But how would, for people that want to find you and talk to you more about your private credit and the loans that you do and find out more
Yeah.
about you, where would they find you?
They could visit us on our website, www.welendllc.com. We're also on all major social media platforms. Our handle is WeLendLLC. And they could also shoot me an email, ruben@welendllc.com.
Perfect. Well, thank you so much for being on here. I enjoyed talking to you, even though we
Same here,
met,
Scott.
recently. I feel like we're gonna have many more conversations
I look
together.
forward to it. I look
Yeah,
forward to it,
me
Scott. Thank you
too.
so much, and the best of luck in the efforts with revolving around the private credit. So good luck with all that.
Well, thank you so much. This is Scott Kidd, the Yacht Captain Investor Podcast. This is a reminder that the best investment that you can make is in yourself. And if you like our content and you like what we talk about, please like, subscribe, share it with your friends. We'd like to hear from you. Let us know what we can do better and what we can help you guys with. Have a great day. We'll see you guys next time.